Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Tuesday. It's September 13th. It's about 7:42 in the morning. We're going to have a big report, the CPI report, in about, in about less than an hour, in about 45 minutes or so, at 8:30 in the morning. Now, the market is holding up really good before the report, which is kind of surprising. It'll be interesting to see how it is after the report. But I'm planning on getting this video out to you guys before the report so you guys know how to handle the report. So as you can see here, we're up about 88 points, 200 points on the Dow, which means the blue chips are not fearing a recession, which is a good sign heading into the CPI report, and the S&P's meeting us in between. Now, the Dow and the S&P have the biggest impact as far as the CPI is concerned from a recessionary perspective. From an inflationary perspective, the NASDAQ has the biggest exposure. But from a recessionary perspective, the blue chips, energy stocks, blue chip stocks do. Because if it's a recession, it doesn't matter how good of a stock it is. Recession means economy slowing down. So it doesn't matter if it's a blue chip or a tech stock, but if it's just an inflationary pressure issue, then it'll hit the NASDAQ a lot more because that's more tailored towards consumer goods, consumer services, tech, and things that are higher priced, generally speaking. What you want to keep your eye on right now is the bond market, which is up 0.74. It's right up here right now. What I'd love to see is the bond market trade above the TLT. This is the ETF that tracks the bonds. Most people here are stock traders, not futures traders, so I use ETFs. What I'd love to see is the TLT trade above the 110 level. If we go above the 110 level, we can get a really good level of safety, and it would also, in my opinion, spark a rally in the consumer discretionary stocks, potentially above the 172 level. The consumer discretionary is one of the weakest sectors, and it's holding on pretty good right now. Now, what's interesting is you have sectors that are still out of whack. You've got utilities, energy, but look at that. You got consumer discretionary. That makes no sense. That makes zero sense, especially with technology and communication services down here. In my opinion, based on everything I know, there is a much higher chance that consumer discretionary will come down before utilities, energy, and healthcare and consumer staples comes down, because consumer discretionary has a much substantial impact as a result of interest rate fluctuations. And we're nowhere near done with our interest rate fluctuations. So I believe this is too early, too fast, and I believe this will come into the trading zone. Do I necessarily believe we're going to go into a bearish market again? No, I believe we're going to be in a choppy wait-and-see market, but I think that some market participants are getting a little too bullish ahead of the curve, a little bit ahead of the curve. Now, remember, we've got this report today. This is going to be coming out in about 45 minutes or so. And we had an 8.5. If this number is lower than 8.5, we're in a good position. If this number, I only care about year over year. I don't care about month over month. It means nothing. If this year over year is at 5.9, 5.8, that's a really good sign for the market. It'll be very interesting to see if the core is higher and if the headline is lower. That's going to add a little complexity to the picture. I'm hoping that both of the numbers are in fact lower. That would be very substantial. Why? Because it would give investors a feel that there is in fact a hope that inflation has peaked. So in terms of the overall put to call ratio, we're still favoring the puts. Look at that. We're at 105. We haven't gone down to the 70 level since March of this year. I mean, it's pretty pathetic. I mean, we went to 80 one time and then we backed away. So we are still favoring the puts, which means there's a lot more pressure on the bear side of the market than the call side of the market. Let's talk about the global economy, and then I'll get into weakest sector, strongest stock, weakest stock. That's what we usually do on Tuesdays. So global stocks, Wall Street futures were higher Tuesday, surprisingly, ahead of data traders hope will show that surging inflation in August has eased, reducing pressure for more interest rate hikes. Don't hold your breath, folks. Investors are waiting for the U.S. government data they hope will show inflation peaked at a 4-decade high of 9.1, which is when the market really tanked. and June and has fallen further after declining 8.5 in July. What we want to see is that there is a trend that's moving lower. That's really what it's all about. It's not about the specifics. Fed officials have affirmed support for substantial rate hikes and to keep borrowing costs elevated for long enough to make sure inflation is in fact extinguished. On Wednesday, that's today, the U.S. Federal report is due to show August inflation at the wholesale levels. Excuse me, that's tomorrow. That's the PPI report. I want to get past the CPI before I get into the PPI. Just too much to talk about. Investors hope receding inflation pressures might prompt the Fed to back off. Not so fast. Similar hopes earlier were dashed when Mr. Jerome, I'm going to tell you the truth after I get reappointed, Powell said August that rates would stay high. And he was right. Surveys show that traders expect the Fed to raise rates this month for the fifth time by 0.75. That's exactly what I'm expecting. 3 times its usual margin. After that, the U.S. Central Bank is expected to hold rates steady through the first half of 2023. If that's the case, I think we can get out of this in one piece. If, in fact, we can get out of this without the bond market really tipping over. Now, as I said, tomorrow we've got the PPI, and then on Thursday we've got retail sales. So we've got industrial production, we've got a lot of data. But I think today's report is going to set tone. Now, what you want to do is you want to keep your eye on consumer discretionary. You want to keep your eye on consumer communications, which is really a subsector of tech, which is already in this area, and another sector, which is technology. These 3 sectors you want to keep your eye on. Now, here's both technology and communication services are already within the range. And I believe, unless we really miraculously start getting out of this recession, that discretionary will start cooling off too, and that's going to put pressure on the bond market. Now, if the bond market can come up, it's already down right now. If the bond market can come up and get into this range, it'll be more beneficial for stocks, and it may cause consumer discretionary to remain outside of that range. But I wouldn't be holding my breath. Let's see if futures changed too. Nope, they're still higher. So it'll be very, very interesting. Now, as far as sectors are concerned, the leading sector is utilities. The lagging sector is communication services. Now, even if you don't go to communication services or you go to technology, you're going to be in the same place because these sectors are lagging right now. And defensive sectors like energy, utilities, healthcare, consumer staples are leading right now. I mean, honestly, I would be very cautious with consumer discretionary. Chips may be the only place there, and that's really a technology issue. So if we look at the top stocks, Enphase, Albemarle, Occidental Petroleum, Quanta. Now, I'm gonna take a cheap shot here, Quanta. I like utilities, and I like Quanta right now quite a lot. I also like Cardinal Health. So either healthcare or utilities. Honestly, if you go to Devon Energy, if you go to, where is it? Occidental, you're not going to be in a bad spot. I like Occidental, I like Quanta, I like Cardinal Health. Genuine Parts is really good right now. Any of these, but utilities top stock, Quanta, it's a power company. Now let's flip this over. NVIDIA, ouch, the worst stock right now. That's because of, I think, the stock split. So let's look at these. Chips are not doing well. You got Micron, you got NVIDIA, Intel. Chips are not doing, Advanced Micro, they're not doing well. But that's the technology sector. Let's first talk about the communication sector. If we go to the communication sector, we got Seagate, we got Charter Communication right here. I do not like this stock. I do not like this stock at all. I mean, at all. So my stock to sell would be Charter Communication. This has been one of the worst stocks this year. So be very, very cautious with it. And again, I don't like the cruise ships and any of those stocks like Expedia, where is Carnival. Don't like any of those. But if we stick to the rules, it'll be Charter Communications. It's one of the XLC stocks. Again, put the call ratios not looking that bad. Keep your eye on the bond market. I'm telling you right now, the bond market is going to give us a full picture. If the bonds start rallying, right, it's going to be good for the stock market. If the bonds stop rallying, it's not going to be good for the market. In terms of sectors, the biggest factor right now is, Are these rallies going to sustain themselves, or are these rallies going to whip out? I think they have another couple of days in them, maybe, possibly. I'd love to see basic materials and some of these stocks get above the last hump, but I think we're going to meet resistance at the last hump on some of them. But as of right now, things are looking good. It'll be very interesting to see what Jerome Powell says. Make sure you tune in at 8:30, and I'll be talking about this report in my VIP room that happens every day, and all my back-end members are welcome. It happens daily at noon today Eastern Time. Now, before I let you go, following the COVID outbreak in 2020 and the flash crash that triggered, Fed printed us out of what could become a recession, right? But where there's consequences, there's always consequences. The easy monetary policy caused the S&P sectors to get out of whack, to deviate from the mean in a way that I've never seen, and I mean that, and I've been doing this for over 28 years. And now, the Fed is in the process of completely shifting gears on their monetary policy. In December of 2021, they started reducing their monetary asset purchases. And in March of 2022, they raised interest rates for the first time in 3 years. In my opinion, the shift away from easy monetary policy is going to flip the markets and create some of the biggest sector rotations and opportunities we've seen. So I want you to click the link below. There's a link for Alpha Rotation. You need to check it out. It's all new. It's brand new. It's all meat and potatoes. It's great stuff. There's a link below this video in the YouTube channel. And if you're watching it on the Wealth Press site, it's there too. Post some comments if you're watching on YouTube channel. I will read them. I'll respond to you. I want to hear from you. Or send me an email, support@marketgeeks.com. Keep your eye on these numbers. In 37 minutes, all hell can break loose. Bye, guys. I'll talk to you later, and I'll give you a full update at noon today. Bye.